What is up, family? This is your man Gideon. I'm so excited today because we're starting a very important topic: Dawes theory. This is one of the most remarkable theories you can come across as far as trading the financial market is concerned. This is one of the most important ones. Yes, there are a lot of theories that you come across, but this one, trust me, is worth your time. So basically, you would ask me, what is Dawes theory? Dawes theory, this is a theory that explains how the stocks market behaved in the past and how the market could be used to measure the health of the business environment and where the market is most likely to move. So in this theory, it explains the behavior of the market, how the market moved in the past, and how that commodity, in terms of how good is that commodity, how healthy is that commodity for you to put in money, how good is that commodity, is it worth it, is it worth it? So it explains that, and it gives you the actual direction to where the market is likely to go. And that's our focus. We need to know where the market is going, guys. That's the main reason to why we are taking this course, is because we need to know where the market is most likely to what, to move. So Dawes theory is very important, guys. Take it very seriously. Trust me, this one is worth your time. So basically, what is the main focus in this theory? Because a lot of things are said in this theory, a lot of concepts are brought forth in this theory, but what's the main focus? Why am I going to teach you this theory? Why are you learning this theory? What's the main focus? So our main focus will look first and foremost, the market discontinues everything. The market discounts everything. Actually, the market discounts everything. That's one concept that we're going to learn from. The second concept we're going to learn from is the three market trends. So in Dawes theory, they are what we call the three market trends. Most of you will be like, no, we've already done the three market trends, which is an uptrend, downtrend, and consolidation trend. Trust me, this is different. And we're going to look into the phases found in these main three trends. So that's a thing. So the market discount everything. Under this segment, the most important thing that we are going to learn, the Dawes theory suggests that all information, past, current, and even future, is discounted into the market and reflects in the price of the stock and index, which simply means this theory is trying to tell us that every movement of the market is actually going to reflect in the stocks or in an index that you're trading. So if you're trading boom and crash, it will actually show in that index. You'll be able to see it. The past, you'll be able to see the past, you'll be able to see the current, and you'll be able to see the future. The moment you just see at this particular index that you are trading. So for example, if you're trading boom or crash, you'll be able to see the actual past, current, and the future movement of the market using this theory called the Dawes theory. So under this segment, it accounts for everything: the past, the current, and even the future. So that information includes everything from the emotions of investors, and also the emotions of the investors is very important. Emotions of the investors. So under this segment, we get to understand the emotions of the investors, to inflation and interest rates data, along with predicting earnings announcements to be made by companies after the close. So before the companies close, before everything closes, this theory will give you the actual emotional state of the investors, people that are trading. The emotional state is very important. It's through this theory that's where you're going to know the emotional state of an investor, the person that is placing the trade that is not you. So that's the thing. And you'll be able to understand inflation and also the interest rate data. It will give you all that. So that's the thing. it's important to note that while Dawes theory itself is focused on price movement and index trades, implementation can also incorporate elements of fundamental analysis, including value and fundamental oriented strategies. So what this is trying to actually explain to us, that it's important that we should know that this segment can include the emotional states of investors, like we have talked about, and inflation state, and also the interest data. But we should take note that Dawes theory overall, it focuses on basically it focuses on the price movement of an index trend. So its main focus is the price movement of an index. That's the main focus. If it's boom, its main focus as far as Dawes theory is concerned is the price movement. And that's a thing that we should learn from here. That's the main reason to why after that we should be able to understand, and therefore Dawes theory is much suited to technical analysis. So the moment a person understands this theory called Dawes theory, you understand that a person is equally like just in the same position with a person that has understood technical analysis. The moment you just understand this theory, guys, you as good as have understood technical analysis. Yeah, you're as good as have understood technical analysis. And an important part of Dawes theory is distinguishing the overall direction of the market. This is the most powerful statement. In fact, the moment you just understand this, you can even close this video and stop watching it, because you have already understood what you want to gain from here. Dawes theory, guys, is distinguishing the overall direction of the market. So the moment a person understands this theory, that person who understands the overall direction of the market will soon see what we are talking about. So the actual three types of trends that we are going to focus on are not uptrend, downtrend, what those trends that we were talking about earlier. But the three trends that we are going to focus on is primary trend, secondary trend, and minor trends. These are the trends that you're going to find in this theory called Dawes theory. This is where the milk starts, guys. This is where the milking of the market starts. Understand this. So we're going to talk about the primary trends, the secondary trends, and the major trends, because this theory focuses on these trends. Understanding these trends is where gaining the money comes from. So what is a primary trend? Primary trend is the major trend of the market, which makes it the most important one to determine. This is nothing but the major trend of the market. It's either bullish or bearish or consolidative. This is a major trend of the market, guys. It's a major one. That's a primary one. So it can either be bearish or bullish. Get the point, right? So in this case, this is an example that I've given you on this sunset crash 1000. Crash 1000. Here, this is the primary trend, which is a what? A bearish trend, a downward trend, a selling trend. So this is how it looks, guys. So this thing is called a primary trend. So according to Dawes theory, we are able to spot this. So the moment a person says to you, said, what trend is this? And you'll be like, this is a downtrend. What you just used there, guys, is called Dawes theory. Yeah. What you just used there is called Dawes theory. And a lot of people don't even know that. They just come into the market and they'll be like, this is a downtrend, this is a uptrend, this is a consolidative. That's the main reason they don't get any money. Trust me, a thing that you have never learned, you don't know. That's what one of my professors actually said to me. Yeah, in one of these sessions, where you get to learn from people that have gone ahead of you. Yeah, because I'm studying other things apart from just being a trader. I'm also studying medicine. So one of my professors said to me that, trust me, the thing that you have not learned, you don't know anything. You might know to say that this is a downtrend, but trust me, you never knew this. This is a primary trend. So this time around, if a person says this is a downtrend or an uptrend, you'll be able to say, okay, this person is actually saying this is just nothing but a primary trend according to those theory. Yeah, so that's the thing. So from there, guys, we're going to go into a secondary trend. A secondary trend is a trend that moves in the opposite direction of the primary trend, or as a collection to the primary trend. This is the movement from a consecutively high to a consecutively low. In a primary downtrend, the secondary trend will be an uptrend move or a relay. I want you to understand this last statement, because we have seen here this is in a downtrend, and they are saying that in a downtrend this will be like in an uptrend. The secondary trend will be in an uptrend, in the sense that a secondary trend, guys, is what we call as a collective trend of the main trend. That's what they are meaning here. So a secondary trend is nothing but a collective trend of the main trend. So for example, here we come again. This is a primary trend. We've looked at this to be a primary trend on Boom 1000 or Clash 1000. So here is a secondary trend, guys. These pullbacks, guys, are what we are calling secondary trends. These pullbacks are secondary trends. So a secondary trend, these are pullbacks. In the main trend, these are pullbacks. So that's the thing. So minor trends, the minor trend is generally the collective move within a secondary move. I hope you're getting that. Or those movements that go against the direction of the secondary trend. So the collective trends of the secondary trends, pullbacks, retracements of the secondary trend, are called minor trends. For example, here we saw this to be a secondary trend. This was a secondary trend, but we are seeing some trends from here up to there. That's a minor trend. From there up to there, that's a minor trend. Here we saw some movement from there up to there, that's a minor trend. From there up to there, that's a minor trend. So that's it, guys. A minor trend, these are small trends that are retracement trends of the secondary trend. Look, the secondary trend is going in an uptrend. I want you to get this. The primary trend is in a downtrend. This is the overall downtrend of the market, like the overall market movement. It's in a downtrend called a primary trend, but the corrective trend is in an uptrend called a secondary trend. But inside these secondary trends, they are corrective trends that are going down, which are opposite this trend that is going up. These ones are called minor trends. In short, minor trends and the primary trends, they are heading towards the same direction, which is a down trend of some sort, down direction. So that's the thing. So that's one thing that you should know. A primary trend and a minor trend, they head in the same direction. The only difference is that a primary trend is the overall trend of the market, but the minor trend is a pullback in a secondary trend, because a secondary trend in an uptrend is in a downtrend is an uptrend. I hope that is clear. A secondary trend in an overall primary downtrend is an uptrend. The secondary, guys, I'll repeat this, the secondary trend is an uptrend in a primary downtrend. I I hope that is clear. So phases, we should understand that these trends are in phases. There is what we call accumulation phase and public participation phase and excess phase. So in accumulation phase, the first stage of a bull market is referred to as the accumulation phase, which is the start of the uptrend. This is also considered the point at which informed investors start to enter the market. So in the accumulation phase, that's where informed traders like you, the person that is getting this information, will be entering from. So us at Trading Billions Academy, we don't enter from participation phase. Yes, we can enter in those ends. Public participation phase, we can enter. I call them the PP. We can enter on the PPP. Yes, we can enter when we missed a bit of a trade, but basically us guys will enter from the accumulation phase. So the accumulation phase typically comes at the end of a downtrend, when everything is seemingly at its worst. But this is also the time when the price of the market is at its most attractive level, because by this point most of the bad news is placed into the market, thereby limiting downward risk and offering attractive variations. So I want you to get one point from here, that at this particular point, guys, this is where the price is the most attractive. It's most attractive, and most people won't understand that this is not going any more down but to start going up. And by it giving you that sign of an accumulation phase, what it does is limiting the downward risk. Hey, it's limiting the downward risk, meaning it makes sure that the downward risk seems very good. It's like there is no risk in me going down, yet it's the most risky part of you going down. However, the accumulation phase can be the most difficult one to spot because it comes at the end of the downtrend move. I want you to get this. That's why it's so difficult to spot this, because it will give you a false limiting downward risk. You'll be like, going down is less risky, going up is more risky, not knowing that it's so difficult to spot because it comes at the end of the downward move, meaning you'd think it's still going down, but in the actual sense the downward move has actually ended, which could be nothing more than a secondary move in a primary downtrend. Which simply means you would think this is just a secondary move, not knowing that this secondary move is actually the one that has started the actual accumulation phase of an uptrend, instead of being the start of a new trend. So that's the thing. I hope that is clear. So public participation phase, this is the phase in which most technical and trend traders start to enter long positions as the new uptrend primary trend has confirmed itself, a sign these participations have waited for. So most traders come to enter the market in the public participation phase. Most traders enter the market on the PPP because at this particular point, or at this particular juncture, I can say most traders will be able to see the confirmations of going into the market. I'll show you that. So basically this is the overview of what I'm talking about. Mainly when the market is coming like that, you discover that it will fail to actually pull down its previous low position when it's coming in and down. Just imagine there is something like that. Just imagine we're having something like this is coming like that. I want you to get to see this. This is coming like that, people. This is an overall, people. This is an overall coming from up there over a downtrend. It's coming from up from up there. What's going on? It's coming from up, and here, yes, it's coming from up there as a primary trend. But look, guys, what happens? It's coming from here as an overall primary trend in a downtrend. You find that this going up there is what we were talking to say that this is a what? A secondary. And from there it continues like going up, but this secondary trend does not, like this primary trend that starts going down does not exceed the previous low. You find that it changes direction and starts consolidating here, making what we are calling a what? An accumulation phase. And from here, I want you to get that, and from here you discover that there are certain things here. You discover that this is what is going on. I want you to see this. I want you to see this. This is what is going on in this market. By this time, it will start doing that. By the time this passes this support and resistance, guys, by the time this passes this support and it breaks out of this support and resistance, most traders will know to say that, okay, the accumulation phase has done what? Has ended. Most people start seeing the accumulation phase from here, like us, or start seeing the accumulation phase from here because of what? Because of Wyckoff. We'll be able to know Wyckoff. I'll teach you Wyckoff. So make sure that you learn Wyckoff. It's like topic number 9. So from here, because of Wyckoff, you'll be able to spot the whole entire accumulation phase. But in most cases, simply today you have learned this theory, so you'll be able to spot this kind of accumulation. I actually even spotted one accumulation today of such kind. Yeah, of such kind, I can say. Yeah, I actually even traded it. I'll actually share the video with you. It's actually the next video before we can actually go on charts. I'll share the video with you so that you can just see what I'm talking about. So from here, guys, what happens is this. Here, after the breakage, after it has broken here, it will come and retest. The moment it comes to retest this zone, most traders will actually enter from here. They will enter from here. For you, starting from today, you will notice that, okay, they are entering here because they have entered the what? A PPP stage, which is a public participation phase. Most of traders will enter from here because they were waiting for what? For a confirmation. But for us, the moment it just reaches here, we know because of Wyckoff. We know to say that here, just from here actually, we know to say that this is going up, guys. By the time we are reaching here, we are just adding positions. We are just adding more positions and more positions. So that's how it works. By the time we are reaching here, we know that this is going up. Because if you noticed what the statement is, what listen to this statement. I want you to listen to it. This is the phase in which most technical and trend traders start to take long position. What is a long position? Like we talked in the other video, these are buy positions. These are buy positions. So most traders will buy from here. They will buy, guys. They will buy, but you just be adding more positions as you're going together with the runners, which are the traders. So we are now on the last phase, which is the access phase. The last stage in an uptrend, the access phase, is the one in which the small money starts to scale back its position, selling them off to those new entering the market. So at this point, these small guys will start selling some positions. They start selling some positions, and by selling some position at that particular height, by selling some position, I think yes. So this, by selling some position, it will shoot up to a point that they will start selling from here, and some traders will be like, I think this will still be going up, not knowing that what has started forming here is what we call a distribution, which is just an opposite of an accumulation. And if we have a distribution, hey guys, niche, we are going down. Niche, we are going down. So that's the thing. So if we see here this point, it simply means if we see such in the market, it's most likely that we are going to see a distribution. So what we are going to do in the next video, I'll show you on how you can actually spot this on a real market charts, and how you can draw this trend line to connect with the distribution. Because the distribution, the moment you scale out this line, you will scale another trend line from this side that will give you, you scale it from here going down here, you scale another trend that will give you the PPP in a downtrend, because this is a PP in an uptrend. So if you scale it out from here, you have a PPP in a downtrend. But ensure that you watch the next video, because I'm going to show you on how I spotted one trade using this same strategy. And again, after that video, we are going to go in on real charts. We are going to start spotting, at least we'll spot about 5 of them, if not less than, but I think 5 of them. Yeah, they are just okay, even 3. We just spot them and try to see from real charts what we are dealing with. So basically that's it. Thank you so much for watching the video and taking your time to actually learn this principle. The only thing that we need to do is watch the next video where I actually traded using this same strategy, and also watch the other video concerning this on how you can spot them on real market charts. So we are going to TradeView, where we're going to actually learn more from real charts. We just need to actually not take this as a theoretical kind of course, like we have said. It's a practical course, but here I'm going to show you a video on how I actually spotted it on my MT5, and I gained some money using the same strategy, actually today, the day I'm making this video. So yeah, so that's the thing. Thank you so much, and see you in the next video. Love you so much.